BlackRock, Vanguard, and State Street. Combined, they manage over $22 trillion in assets. That's more than the GDP of every country on Earth except the United States and China. More than the entire GDP of Japan, Germany, and the UK combined. They are the largest shareholders in 90% of S&P 500 companies. Apple, Microsoft, Amazon, Google, Facebook, JP Morgan, Bank of America, Exxon, Pfizer, Johnson & Johnson. Pick any major corporation, and you'll find these three companies at the top of the shareholder list. But here's what makes this truly terrifying. They don't just own shares, they control voting rights. When BlackRock owns 8% of Apple, and Vanguard owns another 7%, and State Street owns 4%, that's 19% of Apple's voting power controlled by three asset managers. They vote on the board of directors, they vote on executive compensation, they vote on mergers and acquisitions, they vote on corporate strategy, and they do this across every major company in every major industry simultaneously. This isn't capitalism, this isn't free markets, this is centralized control disguised as diversified investment. Three companies, controlling $22 trillion, voting the shares of institutional and retail investors who have no idea their money is being used to consolidate corporate power into the hands of a small group of asset managers who answer to no one. And here's the part that should keep you awake at night. You can't see who owns Vanguard. The ownership structure is secret. BlackRock and State Street are publicly traded, so you can see their shareholders. But Vanguard is privately held, structured as a mutual company owned by the funds it manages. Which sounds democratic until you realize that means nobody actually knows who controls Vanguard, and Vanguard is BlackRock's largest shareholder, and BlackRock is Vanguard's largest shareholder. They own each other. They vote each other's shares, they sit on each other's boards, and together, they own everything. This is the story of how three asset management firms accumulated more power than most governments, how they use that power to control corporate America, and why almost nobody is talking about the greatest concentration of economic power in human history. Let me start with what these companies actually are, because most people have never heard of them. If you have a 401k, a pension, or any kind of investment account, your money is probably being managed by one of these three firms. You just don't know it. BlackRock was founded in 1988 by Larry Fink and 7 partners. It started as a fixed income asset manager, specializing in bonds and risk management. The company grew rapidly through the 1992s and 2000s by acquiring other asset managers and building sophisticated risk analysis software called Aladdin. Aladdin now manages over $21 trillion in assets, not just BlackRock's, but assets for thousands of other institutions globally. That means BlackRock has visibility into the positions, risks, and strategies of most major financial institutions on Earth. By 2025, BlackRock manages approximately $10 trillion in assets. It's the largest asset manager in the world. It manages money for pension funds, sovereign wealth funds, endowments, insurance companies, and individual investors through ETFs and mutual funds. When you buy an ETF like the iShares S&P 500 ETF, you're giving BlackRock your money, and BlackRock votes the shares in that ETF according to their proxy voting policies, not yours. Vanguard was founded in 1975 by John Bogle, who pioneered the index fund. Bogle's vision was democratizing investing, allowing ordinary people to invest in broad market indexes at low cost. Vanguard grew to become the second largest asset manager in the world, managing approximately $8.6 trillion as of 2025. Unlike BlackRock, Vanguard is structured as a mutual company. The funds it manages own Vanguard itself, which theoretically means investors own Vanguard. But in practice, no individual investor has any control or visibility into Vanguard's decision-making. The structure creates a closed loop where Vanguard's leadership answers to no external shareholders, no board that investors can vote on, and no public disclosure requirements beyond what applies to the funds themselves. State Street was founded in 1792, making it one of the oldest financial institutions in America. It's smaller than BlackRock and Vanguard, managing approximately $4.1 trillion, but it's still the third largest asset manager globally. State Street is best known for its SPDR ETFs, including the SPDR S&P 500 ETF, ticker SPY, one of the most traded securities in the world. Combined, BlackRock, Vanguard, and State Street manage over $22 trillion. But the number itself doesn't capture the power. The power comes from concentration. These three firms are the largest shareholders in almost every major publicly traded company in America and increasingly around the world. Let me show you exactly what this looks like. Take Apple, the most valuable company in the world with a market cap around $3.5 trillion. Who owns Apple? You'd think it's widely distributed among millions of individual shareholders. and technically it is. But when you look at institutional ownership, the top shareholders are Vanguard with about 8.5%, BlackRock with about 6.4%, and State Street with about 4%. That's nearly 19% of Apple, controlled by 3 asset managers. Now go to Microsoft, market cap around $3.2 trillion. Top shareholders, Vanguard 8.8%, BlackRock 7.2%, State Street 4.1%. That's 20% controlled by the same 3 firms. Amazon, Vanguard 6.7%, BlackRock 5.6%, State Street 3.9%. Google, Vanguard 7.8%, BlackRock 6.9%, State Street 4.2%. Facebook, Meta, Vanguard 7.9%, BlackRock 6.5%, State Street 4.3%. Do you see the pattern? The big 3 are the top shareholders in every single one of the largest technology companies. But it's not just technology. Go to financials. JP Morgan Chase Vanguard 8.2%, BlackRock 6.8%, State Street 4.5%, Bank of America Vanguard 8.7%, BlackRock 7.1%, State Street 4.9%, Wells Fargo, Citibank, Goldman Sachs, same pattern. Pharmaceuticals. Pfizer, Vanguard 8,9%, BlackRock 7,4%, State Street 4,3%, Johnson & Johnson, Merck, AbbVie, all controlled by the same 3 firms. Energy companies, ExxonMobil, Chevron, ConocoPhillips. Top shareholders are BlackRock, Vanguard, State Street, media companies, Comcast, Disney, Warner Brothers Discovery, all owned by the big 3. Airlines, Delta, United, American, Southwest, same 3 firms. I could go on, but you get the point. These 3 asset managers are the largest shareholders in 90% of the companies in the S&P 500. And it's not just the S&P 500, they're the largest shareholders in most major publicly traded companies globally. They own stakes in European companies, Asian companies, Latin American companies. Wherever public markets exist, BlackRock, Vanguard, and State Street are the top shareholders. Now here's why this matters. Owning shares means owning voting rights. When a company holds a shareholder vote on board members, on executive pay, on mergers, on corporate governance, the votes are cast by shareholders. For most individual investors, they don't vote, they don't even know there's a vote. But institutional investors vote every single share they control. And BlackRock, Vanguard, and State Street control the voting rights on trillions of dollars of shares that belong to other people. When you invest in a BlackRock ETF, BlackRock votes your shares. You don't get to vote. You gave BlackRock your money, they bought shares on your behalf, and they vote those shares according to BlackRock's proxy voting guidelines. The same is true for Vanguard and State Street. This means 3 companies, controlled by a small number of executives, are casting votes that represent trillions of dollars of other people's money. Let me show you what this looks like in practice. In 2021, there was a proxy fight at ExxonMobil. An activist hedge fund called Engine No. 1, which owned only 0.02% of Exxon, wanted to replace some board members with directors focused on climate transition. This tiny hedge fund, owning almost nothing, won. They got 3 board seats. How? Because BlackRock, Vanguard, and State Street voted with them. Those 3 firms controlled enough shares that when they voted yes, the activist won despite owning almost nothing. Now, you might think that's good. Climate activism, holding oil companies accountable, sounds positive. But think about the mechanism. 3 asset managers overruled the majority of Exxon's individual shareholders and the existing board because those 3 firms controlled enough voting power. The outcome might have been positive in this case, but the structure is terrifying. 3 companies can change the board of any major corporation anytime they want because they control the votes. And it's not just Exxon. In every major proxy fight, every board election, every shareholder vote at every major company, the outcome is determined by how BlackRock, Vanguard, and State Street vote. Individual shareholders are irrelevant. Small institutional investors are irrelevant. The big 3 decide. This creates a fundamental problem. These 3 firms have enormous power over corporate strategy, but they have no accountability. BlackRock's Larry Fink can send a letter to every CEO saying he wants companies to focus on ESG, environmental, social, and governance factors, and every CEO listens because BlackRock controls the votes. If Fink says your board will face opposition unless you adopt certain policies, you adopt those policies. Not because your shareholders want it, but because the asset manager voting your shareholders' shares wants it. Now let's talk about the cross-ownership structure, because this is where it gets truly dystopian. BlackRock is a publicly traded company. You can look up who owns BlackRock. The largest shareholder is Vanguard, owning about 8.5% of BlackRock. The second largest is BlackRock itself, through treasury shares and employee funds. State Street is also a major shareholder. Now look at State Street. It's also publicly traded. The largest shareholder is Vanguard, about 9.1%. The second largest is BlackRock, about 7.8%. Vanguard and BlackRock own State Street. Now look at Vanguard. You can't. Vanguard's ownership is opaque. It's structured as a mutual company owned by the funds, but the funds are managed by Vanguard. So Vanguard owns Vanguard, which means nobody owns Vanguard, which means the executives running Vanguard answer to no one. But here's what we do know. Vanguard's funds own massive stakes in BlackRock and State Street, and BlackRock's funds own massive stakes in Vanguard's funds' underlying holdings. They own each other in a circular structure that makes it impossible to determine where control actually resides. This isn't conspiracy theory. This is publicly disclosed information. Go to the SEC filings. Look at the 13 F forms that institutional investors must file quarterly. You'll see BlackRock listed as a major shareholder in Vanguard funds' holdings. You'll see Vanguard listed as a major shareholder in BlackRock and State Street. They own each other, and together they own everything else. The implications are staggering. These three firms, which own each other, control the voting rights in 90% of major corporations. They sit on the boards, they influence strategy, they determine executive compensation, and they do this across competing companies in the same industry simultaneously. BlackRock, Vanguard, and State Street are the top shareholders in Coca-Cola and Pepsi. They're the top shareholders in McDonald's and Burger King. They're the top shareholders in Delta and United. They're the top shareholders in CVS and Walgreens. They own competitors. They vote the shares of competitors. They sit on the boards of competitors. This should be illegal. Antitrust law is supposed to prevent this. The Clayton Antitrust Act prohibits interlocking directorates, where the same people sit on the boards of competing companies. But it doesn't clearly prohibit the same shareholders from owning large stakes in competitors, especially when those shareholders are passive investors claiming they don't exercise control. BlackRock, Vanguard, and State Street argue they're passive. They say they simply track indexes, they don't actively manage companies, they don't make strategic decisions, but that's a lie. They vote. They send letters to CEOs. They issue proxy voting guidelines that every company must follow to avoid opposition. That's not passive, that's control. And the concentration is getting worse. In 1980, the top 5 institutional investors owned about 10% of the average S&P 500 company. By 2000, it was 20%. By 2020, it was over 25%. And most of that increase has gone to BlackRock, Vanguard, and State Street. As passive index investing has grown, as 401ks and IRAs have shifted from individual stocks to index funds and ETFs, the big three have accumulated more and more control. Here's the math. The S&P 500 has a total market cap of about $45 trillion. If the big three own 20% on average, that's $9 trillion of the S&P 500 alone. Add in their holdings in international stocks, bonds, real estate, and other assets, and you get to $22 trillion total. But the $9 trillion in equities is where the power lies, because equities come with votes. Now, let's talk about how they got here, because this didn't happen by accident. This was built systematically over 40 years through regulatory changes, financial innovation, and the shift from active to passive investing. In 1974, Congress passed ERISA, the Employee Retirement Income Security Act. This law changed how pensions worked. Before ERISA, most pensions were defined benefit plans. Your employer promised you a certain payout in retirement, and they managed the investments. After ERISA, companies shifted to defined contribution plans like 401ks. You contribute, your employer might match, but you're responsible for managing the investments. This shift pushed millions of Americans into the stock market. But most people don't know how to pick stocks, so they invest in mutual funds and ETFs. And who offers the biggest, cheapest, most accessible mutual funds and ETFs? BlackRock, Vanguard, State Street. In 1975, John Bogle launched the first index fund at Vanguard. It was revolutionary. Instead of trying to beat the market, just own the whole market. The Vanguard 500 index fund bought every stock in the S&P 500 inches proportion to market cap. Low fees, broad diversification, easy. Index funds exploded in popularity. By 2025, passive index funds and ETFs hold over $15 trillion in U.S. equities, and the vast majority of that is managed by BlackRock, Vanguard, and State Street. BlackRock's rise came through financial innovation and crisis opportunism. In 2009, after the financial crisis, the Federal Reserve needed help managing all the toxic assets they'd bought during the bailouts. Who did they hire? BlackRock. The company that manages $10 trillion was hired by the government to manage the government's crisis assets. This gave BlackRock unprecedented access to government decision-making and cemented their role as the financial system's central planner. State Street grew through ETF dominance. Their SPDR S&P 500 ETF, launched in 1993, became one of the most traded securities in the world. As ETFs became the preferred vehicle for institutional and retail investors, State Street's assets under management exploded. By 2010, the Big Three were already dominant. By 2020, they were unstoppable. And by 2025, they control more wealth than any empire in history. Now let's talk about the conflicts of interest and why this structure is fundamentally broken. When BlackRock owns both Exxon and Tesla, how do they vote on climate policy? Do they push Exxon to drill more oil, which benefits Exxon shareholders, or do they push Exxon to transition away from oil, which benefits Tesla shareholders? They can't maximize value for both. Their interests are directly opposed. When Vanguard owns both airlines and Boeing, how do they vote on airplane orders? Do they push airlines to buy more planes, benefiting Boeing, or do they push airlines to reduce capacity and increase prices, benefiting airline shareholders? When State Street owns both banks and fintech disruptors, do they push banks to adopt technology, helping fintechs, or do they push banks to lobby against fintech regulation, protecting traditional banks? These conflicts are irreconcilable, but the Big Three don't have to choose. They vote however they want with no accountability because the money isn't theirs. They're voting shares that belong to millions of individual investors who have no say in how the votes are cast. And there's a darker implication. When the same shareholders own all competitors in an industry, those competitors have less incentive to compete. If BlackRock owns 7% of Delta and 7% of United, BlackRock benefits when airlines collude to raise prices. Higher prices mean higher profits for both airlines, which means higher returns for BlackRock. Competition hurts BlackRock because it reduces profits. Academic research has confirmed this. Studies show that industries with high common ownership, meaning the same institutional investors own large stakes in multiple competitors, have less competition, higher prices, and lower innovation. Airlines, banking, pharmaceuticals, tech, all industries dominated by common ownership from BlackRock, Vanguard, and State Street, all show reduced competition. This is monopoly, but it's not one company dominating an industry. It's one shareholder dominating all companies in the industry. And it's legal because antitrust law hasn't caught up to the passive investing revolution. So what happens next? This concentration is accelerating. Every year, more money flows into passive index funds. Every year, BlackRock, Vanguard, and State Street accumulate more shares. Every year, their voting power increases. At the current trajectory, by 2030, the Big Three will own 30% of the average S&P 500 company. By 2040, they could own 40%. At some point, they'll own the majority. And when they do, corporate democracy ends. Shareholder votes become formalities. The Big Three decide everything. There are two possible futures. In the first, regulators wake up. Antitrust authorities recognize that common ownership by massive asset managers is anti-competitive. They pass laws limiting how much of any company or industry the Big Three can own. They require asset managers to give voting rights back to individual investors. They break up the concentration. In the second future, nothing changes. The Big Three continue growing. They become the permanent ruling class of corporate America. Every CEO answers to them. Every board is chosen by them. Every major economic decision flows through three companies in New York and Boston. Democracy and politics might survive, but economic democracy dies. Which future happens depends on whether enough people understand what's happening. Right now, most people don't. They invest in index funds thinking they're participating in free markets. They don't realize they're funding the consolidation of corporate power into the hands of three unaccountable asset managers. BlackRock, Vanguard, and State Street didn't steal this power. We gave it to them. Every time you invest in an index fund, you're giving them your voting rights. Every time your 401k buys an ETF, you're expanding their control. It's legal. It's efficient. And it's the greatest concentration of economic power in human history, built in plain sight while everyone was told they were diversifying their portfolios. The Big Three don't own half the world's wealth. They own something more important. They own the votes. And in corporate America, votes are power. $22 trillion in assets, 20% of every major company, control over the boards, control over strategy, control over everything. 3 companies, 3 CEOs, 1 system, and almost nobody knows it exists.